All right, let's dive right into this. Welcome to today's explainer, where we're going to transform ourselves into financial detectives. Because honestly, assessing a business's financial position and performance, it's basically investigative work. You aren't just staring at a boring balance sheet or an income statement, you are actively looking for clues, uncovering hidden evidence, and piecing together a comprehensive story about how healthy or maybe how vulnerable a company truly is. We're going to go way beyond the basic numbers today to look at the real strategies actually driving them.
So here is our investigative agenda for today. First, we'll pack our detective's toolkit. Then, Task 1, benchmarking our suspects. Task 2, interpreting real PLC data. Task 3, the missing evidence. And finally, we'll look beyond the balance sheet.
Let's kick things off with Section 1, the detective's toolkit.
Now, before we can solve the case of a company's financial health, we absolutely need to know how to categorize this massive mountain of raw financial clues into logical, manageable buckets. Think of profitability, returns, and shareholder rewards as the vital pulse of the business. Like, are they actually generating money from their daily operations and capital? Under profitability, we look at gross, operating, and profit for the year margins. These essentially show us how effectively a business converts its revenue into actual bottom-line profit at different stages. Then we have returns, things like return on capital employed, or ROCE, and return on investment, ROI. These metrics are crucial because they tell us how efficiently the business is using the capital poured into it. And finally, we check shareholder rewards, like dividend per share and dividend yield. This tells us exactly how well the owners are being compensated for taking on all that financial risk.
Okay, so if profitability is the pulse, then liquidity and risk metrics, they are the immune system. Can this business survive a sudden shock? Under liquidity, we've got cash flow, the current ratio, and the acid test ratio. These are our short-term clues. Basically, can the business pay its immediate bills without panicking? On the risk and efficiency side, we look at the break-even output. Literally, exactly how much they need to sell just to cover their costs, and the margin of safety, which is the safety buffer they have if sales suddenly drop off a cliff.
And within that risk category, we have a really vital definition you need to know: gearing. Gearing is the extent to which a company relies on debt, its non-current liabilities, as opposed to equity or shareholders' funds to finance its operations. The crucial takeaway here is that a highly geared business is carrying a ton of borrowed money. And sure, while debt can totally fuel rapid growth, it also brings mandatory interest payments. So, if the market takes a downturn, high gearing is a massive red flag pointing straight to intense financial stress.
Another super helpful tool in our kit is budget variance. This is simply the process of comparing actual financial performance with the original budgeted or expected figures. Remember, a variance can be favorable or adverse. If a company's actual costs end up being way lower than expected, or revenues are higher, that's a favorable variance. It's a fantastic clue that the financial performance is actually beating management's initial expectations. It really signals that their operational controls are highly effective.
Moving right along to Section 2, Task 1, benchmarking the suspects.
So here is the absolute golden rule of our investigation. A single financial metric, evaluated completely in isolation, is practically useless. We have to have context. Let's say you calculate a business's return on capital employed, its ROCE, and it comes out to 12%. On its own, generating a 12% return sounds pretty solid, right? You'd take that. But when you benchmark it against the broader industry average of 18% and its main competitor, who is hitting 15%, suddenly that 12% looks like a bit of a problem. By comparing against rivals and industry standards, we instantly transform a raw floating number into actionable competitive analysis. We now know this business is actually lagging behind.
But wait, before we totally condemn them for that 12% ROCE, we've got to remember that context matters. Why do the numbers look the way they do? We have to evaluate the business's specific objectives and its strategy. Are they intentionally sacrificing short-term profit margins right now to heavily invest in market penetration or maybe some crazy new product development? What's the current economic environment like overall? Past historical trends and strategic business planning are the essential backdrops that actually explain the why behind the numbers on our spreadsheet.
All right, Section 3, Task 2, interpreting PLC data.
Let's really put our detective hats on now and analyze a real-world case file using data from a public limited company. Take a look at this specific number, 0.74. This was the current ratio calculated for the major clothing brand Gymshark back in 2024.
Now, think back to our toolkit. The current ratio measures liquidity by dividing current assets by current liabilities. Generally, a healthy ratio is considered to be somewhere between 1.5 and 2. So, a ratio of 0.74? That is a highly significant clue. It literally means they had only 74 pence in liquid assets for every single pound of short-term debt they owed. Plus, this was noticeably lower than the UK clothing industry average at the time.
So I'm going to pose this question directly to you. Based on this single piece of evidence, is this business safe? When a company's ratio drops this far below 1, it strongly suggests potential and very immediate liquidity problems. It creates real, tangible concern about the company's ability to settle its current liabilities as they fall due over the next 12 months. And the consequences of a weak liquidity position like that are super immediate. If cash is tight, the business might need to urgently sell off assets, and they'll probably have to do it at a loss. They might be forced to take out an expensive short-term loan, which of course eats into future profits through interest payments. Or they might resort to delaying their payables, basically stretching out the time it takes to pay their own suppliers. Sure, this might temporarily fix their cash flow, but it massively risks alienating essential supply chain partners and ruining vital trade credit relationships. It's a dangerous game. But let's look at another piece of evidence from a completely different angle: 11%. Imagine we are evaluating a business's decision to expand into a brand new region, and our calculation shows an 11% return on investment, or ROI. Now, unlike the current ratio, which measures immediate risk, ROI measures the attractiveness of a future strategic move. If the cost of borrowing capital for this big expansion is, say, 8%, then securing an 11% return absolutely proves this investment is financially viable and highly attractive. It just goes to show how different clues tell us very different things about corporate strategy.
Which brings us to Section 4, Task 3, the missing evidence.
As financial detectives, our greatest skill is not just reading the numbers, but understanding the limits of those numbers. We have to evaluate what the financial data isn't telling us. Let's quickly contrast our data sources here. On one side, we have financial data, balance sheets, income statements, profitability margins. This is quantitative, it's hard math, but crucially, it is strictly historic. It only tells us what has already happened. On the flip side, we have non-financial data, things like staff morale, brand reputation, environmental impact. This is qualitative, it's definitely harder to measure, but it is often forward-looking. It tells us what is going to happen to the company's long-term competitiveness. So, when you look at it that way, the limitations of financial reporting become glaringly obvious. Relying solely on financial data simply does not provide a reliable assessment of long-term health. An income statement completely ignores whether the staff is totally burned out and ready to walk out the door, which would absolutely devastate future productivity. A balance sheet ignores the strength of the brand's reputation in the eyes of the consumer. It also completely misses the business's environmental impact or carbon footprint, factors that are increasingly dictating consumer choice and even triggering regulatory fines. These missing pieces of evidence are absolutely critical to a complete investigation.
Finally, Section 5, beyond the balance sheet.
To truly assess business health, we have to synthesize the hard numbers with the intangible assets that actually drive those numbers. As the quote goes, customers buy the product, not the culture, but culture is difficult to imitate and provides a strong source of competitiveness. Ultimately, competitiveness comes from what people are willing to pay for. But if a business has established a distinctive identity and a really well-understood, effective internal culture, they've built a moat against competitors. This intangible, non-financial asset is exactly what secures brand loyalty and eventually drives up the very ROCE and profit margins we've been analyzing on those spreadsheets.
So I'm going to leave you with this final provocative thought for our explainer today. Would you invest in a highly profitable company if you knew it had a completely toxic culture and falling brand loyalty? The numbers today might look absolutely fantastic, but our detective work tells us the foundation is crumbling underneath. To be truly effective in assessing business health, you must balance the undeniable math of the balance sheet against the crucial missing evidence of human and strategic factors. Thanks so much for joining me on this investigation.